Hello, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me as he does each and every week from some remote location in South America is Green Zone Fortunes co-editor Charles Sizemore. I'm kidding. It's not remote. I know exactly where he is, but I'm not going to tell you just because I don't want you to guess. But anyway, Charles, we're here for another episode of Investing with Charles. Now, in the last 2 weeks, we've talked about dividend yield and we've talked about dividend growth. Now, this week's question comes from Joanna, who asks about another factor in dividends and what you look at in terms of dividends, and that is yield on cost. So I'm going to ask you very point blank, very simple. What is yield on cost?
Yeah, sure. First off, I love this metric. I love the concept of yield on cost. It's not the sort of thing you really look at when choosing what to buy ahead of time. It's more of just a conceptual way to think about dividend growth. And so what is yield on cost? Yield on cost is you take the current dividend, you take the current annualized dividend, and you divide that by the purchase price of the stock when you bought it, whether it was last week or 10 years ago or 1,000 years ago at the beginning of time, whatever. Whenever that you first bought that stock, you compare that price to the current dividend, and that gives you a yield based on that original price. And so if you have a stock that has been growing its dividend, that yield on cost looks larger with the passing of time. Right? That's exactly what it's supposed to do. And kind of the takeaway from that is it doesn't tell you what to buy today necessarily, but it does give you this kind of framework to see how dividend growth works.
So, I mean, I'll ask you for a specific example because I know you have one in terms of how this looks, and we'll try to show this on the video as well. But give me an example of yield on cost and how it can work.
Yeah, so in order to illustrate, I picked a stock that is kind of a mainstay in dividend portfolios. It's very popular with income investors, precisely because it pays a good yield. It's very bond-like in its operations, and it has a very, very long history of raising its dividend. It raises its dividend about 4 times a year and has for, I think, about a decade now. It's been a long stretch of raising that dividend every quarter. And drum roll, the stock is Realty Income, very conservative triple net REIT, real estate investment trust. And so this is a fine example because this stock regularly raises its dividend. That yield on cost looks really good with the passing of time. I actually scrolled down some numbers here. The dividend yield today, based on today's prices, is 4.6%. That's good. Like that's a good yield in today's environment. Now, in June of 2012, 10 years ago, the dividend yield at the time was not too different from what we have today. It was about 4.2%. If you had initiated a position 10 years ago, you would have gotten a 4.2% dividend yield right off the bat. But if you had held those shares to today, then your dividend today compared to that original purchase price would give you a 7.3% yield. Well, now we're talking. That's significantly better than just about anything you're going to find in the market today that's not quite risky. Now let's go a step further. Let's go back 20 years. 20 years may sound like a long time, but if we retire in our late 60s, early 70s, and we survive to 90, that's 20 years in retirement. You could easily go 20 years in retirement. So a horizon of that time frame is actually pretty realistic. So drum roll, if you had bought Realty Income in June of 2002, you would have gotten a 6.2% dividend yield at that time, which is super. Those kind of yields barely exist today. But again, drum roll, anticipation, it's building. Your yield on cost would be, so wait for it. Your yield on cost would be 16.6%. That's almost 17% yield on that original investment. So does that mean you have to run out and buy Realty Income today? Well, it's a good dividend stock. I think you definitely would be well served if you did. But it's more, this shows the power of dividend growth. And Realty Income is not a stock that raises its dividend by 10, 20% a year. It raises its dividend by 4 to 5% a year. And even at 4 to 5% dividend growth, that's the kind of yield on cost you realize.
So I'll throw you a little bit of a curveball before we break away here. Are there any pitfalls to using yield on cost as an instrument to measure a stock?
Yeah. So the only pitfall would be if you're looking at, if you're just trying to gauge, okay, so this is what it would have looked like over the last 10 or 20 years. Is that a reasonable assessment of what it's going to look like over the next 10 or 20 years? You just have to look at the company's health. Like, is this a healthy company? Are they able to raise their dividend at the levels they have in the past? And if the answer is probably yes, this company looks as good today as it did 10 years ago. I would expect the dividend growth to look similar going forward as it has in the past. Then the yield on cost could actually be a really good estimate of what kind of future yield on cost you could enjoy.
Okay. So basically the in round here, I guess, give me the summation in terms of yield on cost.
Yield on cost is a really nice way to just put dividend growth in tangible terms. If I'm a dividend growth investor, if I'm wanting to stay ahead of inflation, if I'm wanting to make sure my income stream gets a little bit better every year, I get a little bit richer every year, more income coming in, then yield on cost can be a really good way to sort of back of the envelope estimate what that's going to look like going forward.
And speaking of yields, next week, we're going to talk about something that's been big in the news of late, especially with the recent market downturn, and that is bonds. Bonds have been talked about quite a bit of late, just because the market has been down, then back up, then back down. But bonds have been kind of a headline in financial news lately. We're going to talk about that. If you do have a question about bonds that you'd like Charles to dive into, we'd love to get that from you. Just email us. The email address is feedback@moneyandmarkets.com, or you can comment down below here on YouTube. Either way, if you do ask a question and we use it, and this goes for any of our videos, whether it's me or Adam or Charles, any of us, if we do use it, we're going to send you some free Money and Markets gear, like Joanna's going to get hooked up with. We've got some hats, t-shirts, sweatshirts, all sorts of great stuff. We will get you connected with that. Before we leave, I do want to make sure that you check out moneyandmarkets.com. It is your home for safe, sound, smart, simple, profitable investment information. Sign up for our free daily e-letter if you're not already. We have our Stock Power Daily, which I am very, very proud to write, where I give you one stock based on Adam's proprietary stock power rating system that is something to consider for your portfolio. Some of these do actually include dividend stocks that Charles talks about on a regular basis as well. I encourage you to check all that out. It's on moneyandmarkets.com. He is Charles Sizemore. He is the co-editor of Green Zone Fortunes. I am Matt Clark, the research analyst for Money and Markets. Until next time, everyone, safe trading.